On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope you're all well, hope you're enjoying the holidays. If you're on holiday, what I'm doing right here is looking back through the archives, looking at some of the really popular podcasts that people found useful, that they found interesting, that they gave me some good feedback on, and doing a bit of a recap on those for anyone that might have missed them or for anyone that might want to hear those again. And so the first one I'm going to pick up on is something I wrote and recorded back in June, and it was called How Do the World's Wealthiest Families Invest and What Can We Learn From Them? Let me just turn my email off because I'm going to keep getting emails while I'm talking. It's going to put me off my train of thought. Now, I wrote this back in June because it came after the release of the 2025 edition of the UBS Global Family Office Report. And that comes out every year. You can find it online. If you don't know how to track it down, then just drop me a line on LinkedIn or wherever and I'll show you where to find it because it is public. It offered some really fascinating insights into how the world's wealthiest families think about risk, time, and opportunity. So UBS surveyed over 300 family office clients for this survey, and it is really the richest of the rich. The average net worth of the families that responded was almost $3 billion US, and their family office teams manage more than $1 billion US each. So we learnt a lot. It talks about attitudes to risk, governance, running costs, staffing, succession planning. They do run these like they're a little business. But what I found most interesting is where they put their money. That's the bit that interests me the most. And at a really high level, their average asset allocation, and asset allocation, of course, is that mix of different asset classes, shares, bonds, property, all the rest of it. Their average asset allocation is not too dissimilar from what you'd see in a New Zealand managed fund, in the growth category, or what an individual investor like you or I might have with a growth-focused risk profile. But there are some really key differences that are worth taking note of, and the most obvious is that they have a 33% allocation. That's a third of their portfolio in alternative assets. And there's no official definition of what this category includes. You ask 5 people, what is alternative assets? You might get some slightly different answers. But alternative assets are generally thought of as anything that sits outside those traditional investment classes. Shares, bonds, which is fixed income, and cash. So anything outside of shares, bonds, and cash is probably alternatives. Real estate is often included in alternatives, and it represents about 11% of those family office portfolios. I'm going to focus on the other stuff because New Zealanders already have a real estate exposure in most cases. So for me, it's all the other bits and pieces that are really worth talking about to all of you. And the rest of that alternative assets bucket includes things like private equity, private debt, hedge funds, artwork, antiques, gold, commodities, infrastructure. Many people would put crypto in that bucket these days too, because, where else is it going to go? Private equity represents the lion's share of this. It is almost 2/3 of the alternative assets bucket for these wealthy families and 21% of the total asset allocation. So private equity is the main one that these wealthy families own. And that means holdings in unlisted businesses as opposed to listed equities that anyone can buy. So Microsoft, Apple, Nvidia, they are all listed on the share market, so they come under listed equities. Private equity would be holdings in private businesses, unlisted businesses. And those typically, but not always, but typically offer the potential for higher returns. And you obviously open yourselves up to a much wider range of investment opportunities because if you're looking at listed markets and then you're including unlisted as well, the world really does become your oyster. However, there are some things we need to consider if you're looking at those sorts of assets like private equity. Fees are typically higher, the complexity is typically higher, and you often, but not always, need a much larger minimum investment that you need to consider as well. So you can't just go and buy one share for, $10. You need to put a little more into those sorts of assets as a minimum. Private equity can also be very illiquid, so you can't sell your holding quickly and easily. You can sell some Apple shares very quickly, very easily, very cheaply. If you own a stake in a private business, not the same. So you really do need to go in with a multi-year view, ideally a 10-year view, in my opinion. Now, none of those constraints or limitations would bother the typical family office, and an extended investment horizon, that longer time horizon, 10 years, 20 years, 50 years, that is actually a feature of their approach. That is how they think. That is how they operate. It's family money. It's intergenerational, and that gives the uber rich a key advantage over many other investors, the fact that they can and they do take that really long-term view. They think and they invest in a truly intergenerational manner. So to be honest, their approach is closer to what you'd see from the likes of the New Zealand Super Fund than an individual investor. So it is a different kettle of fish. Now, the other 12% that we're talking about, so it's 21 that's in private equity, and remember I said 33 overall, so where's the other 12 gone? Remember I've excluded real estate, so where's that other 12% of their portfolios? Well, that is spread across the other alternatives. Private debt and hedge funds, those are the biggest at 4% each, and the rest would be much smaller, your gold, your commodities, your infrastructure, and so forth. Now, another question that you'll probably be thinking is, well, if they've got 33% in alternative assets, that is a big number. And what have they reduced to make room for that? Well, mainly it's listed equities. So listed equities come in at an average of 30%. So if you add those two together, you've got 30 and you've got 33, 63%, and then you're actually quite close to the 70% weighting that the average growth fund has in New Zealand to equities, but it's all listed equities. So what they've really done is they have cut a whole big chunk off their listed equities, put that into alternatives. Beyond that, what have they done? Well, family offices have about 19% in traditional fixed income or bonds. They have about 6% in cash. And those numbers are actually pretty similar to what you'd get from our typical managed fund in the growth bucket. And I've got these figures off sorted.co.nz, so you can go in and have a look what the typical growth fund, balance fund has. I've looked at growth funds because they're closer in terms of their risk profile. So family offices 19 and 6. Our growth managed funds 13 and 9, not a world apart. So the real difference with how these super rich families invest is that hefty weighting to alternatives, which is dominated by private equity, but it also includes the likes of gold, infrastructure, private credit, all the rest of it. So what can we learn for that as investors? Well, if we wanted to take a leaf out of that book, then we would want to think about adding some alternative assets to our portfolios. And in the old days, that was really hard to do unless you were a wholesale investor, a very wealthy investor, unless you knew the right people, really hard to do. Not as difficult these days. Those types of assets are not nearly as unattainable as they once were. There are diversified alternative asset funds that are available right here in the local market, managed by global specialists, but structured in a way that is tax efficient for Kiwi investors. So few of us have billions to invest, like these family offices in the UBS survey, but we can still learn from what they do, especially when it comes to thinking long term, especially when it comes to thinking beyond those traditional markets. There is more to the world of investing then the NZX50, the ASX 200, and the S&P 500. There is a whole world of other assets out there. So if you want to know more, take a look at that survey, have a read, hit me up if you can't find it, talk to your advisor if you want to know whether you can introduce some of these other types of assets into your portfolio and find out whether they are appropriate for you, because they might not be, but if they are, maybe worth a look. All right, enjoy your day, team. We'll talk again soon.
For more insights, visit craigsip.com.